really explain what the LCP position is with regard to the future of DB schemes. Over to you, Steve.
Sorry. Yeah, good morning, everyone. I'm very happy to be here. I've heard lots of rumours about this session and what to expect, so I hope you live up to everything I've been told. So the LCP position, an interesting phrase of a partnership of 150 plus people, but our position, certainly amongst the subgroup that I've been working with, is that there may well be a better answer to DB pensions than how they are currently being run. The status quo is by no means a bad situation, and certainly through the narrow lens of a DB member's perspective, actually these schemes have never been better funded. Insurance transactions provide extra layers of security, pretty good track record, etc., etc. So the status quo, I think, is one of success. Schemes have been championed into a very strong funding position with lots of assets. And really, we're revisiting that from a position of strength and saying, actually, could we be more ambitious than the status quo? Is there something better to be done than simply let these assets exhaust themselves paying the pensions as they currently stand? So we've been having a think around that question for about a year. We went through a rebrand as a firm. I don't normally let the branding people dictate my academic thinking, but in this case, the rebrand was Powering Possibility, which is a grandiose title. And I thought that's certainly true in some aspects of our business around healthcare and energy. Is it true in what we're doing with DB pensions? Are we powering possibility, or is there something more that we could do? So we've been thinking around that problem. We've come up with a solution that we've been talking about sort of behind the scenes in certain groups for 6 to 9 months. We got to the point of wanting to talk much more externally around it, being in Westminster, talking to various groups, submitted replies to the DWP's call for evidence. And effectively, it's quite simple. Change two things. Change the PPF to provide 100% coverage of benefits. We think the PPF currently provides sort of 90 to 95, and that proportion goes up through time as members age. Tweak it up to 100. PPF has been a big success story, very well funded. Looks like that model works. When things break down, have that provided centrally. Then question 2 is, should schemes be allowed to use surpluses more actively on a more ongoing basis? We think they should. We think for a very well-funded scheme that's got 100% coverage from the PPF that's get even more overfunded, you should be able to take some money back out and then share that amongst the various stakeholders. And we think taking together, that changes the incentive structure for those managing DB schemes. Currently, if you're managing a DB scheme, if you're a trustee, you've got very little incentive to do anything other than de-risk and buy out. Your job is to protect the benefits that have already happened and nothing else. Whereas we think with the change in the rules, actually now you might have a new set of incentives that will allow people to invest these schemes in more proper investment strategies, to use the air quotes, generate tens of billions, if not a trillion pounds of extra money over the decades ahead, and share that amongst the various stakeholders. So that's the fairly ambitious plan of where we got to, and we think now's an interesting time to be talking about it.
Well, thanks very much indeed. And I don't think that anyone would argue that schemes, including the PPF, could be more ambitious in the way in which they behave, and they have done so far. But the first question I have for you is, what's stopping this happening at the moment? Why can't pension schemes be more ambitious than they are? What are the headwinds we've got to get rid of?
Two things. So trustees hold the keys, make the investment decisions, decide what to do. The trustees' fiduciary duty is to the members' accrued benefits. And through that narrowed lens, investing for growth, being ambitious, there's no reason to do that. And actually, most of the time, you'd be criticised as a trustee for trying to do anything else. So the trustee focus, supported by common legal views, is if you can de-risk, de-risk. If you can buy out, buy out. Even if you just think moderately ambitiously about increasing your existing members' benefits in a period of high inflation, well, our job's about the benefits that have been accrued under the rules of the scheme, nothing more. So that's one headwind. Trustees and their fiduciary duty, we need to find a way around that problem. The other headwind is I guess the corporate Britain that sponsors these schemes. They don't necessarily want lots of risk associated with the pension scheme and potential for huge contributions being required. And actually, I mean, corporate Britain's been trained for 20 years to think of DB pensions as a problem, not an opportunity. So I think there's a mindset point there of, hold on a sec, I don't know loads about DB pensions, but I know it's something I don't want. So I think there's a bit of a re-education piece that needs to be done there.
Yeah, I like that formulation. There was a time when we used to think of our pension schemes as opportunities. Those of us who were thinking about pensions in the last century actually used to regard DB pension schemes as Britain's great economic miracle, to use the phrase of Frank Field. So good news that we're actually starting to think about that again. I guess if I was being cynical, I would say that after 15 years of hardcore de-risking, to see the consultancies moving towards keeping schemes open as a kind of jobs for the boys and girls might be a criticism that could be levied against you. Are you being opportunistic in changing tack in this way, and how would you defend yourself against that criticism?
Not a question I wasn't expecting, Henry. Yeah, so the first part of the answer is that academically, looking at the situation, looking at all of the stakeholders, all of the implications, I think running on the schemes with modest amount of investment return for the benefit of everyone is the right answer. We're not pushing something that we fundamentally think is the wrong answer. That's my view. That's my personal view. There'll be others at LCP who have a different view to that. I think one other interesting aspect of me speaking as a partner of LCP on this is that we've got the leading buyout de-risking practice. And I think it would be harder for me to credibly say that there are better alternatives if I worked for a firm that didn't make any money doing buyout work, because that might feel a bit, and let's face it, I think we might have been criticised in the past for pushing buyouts for commercial reasons. So I think there's that aspect to it too, that actually there's commercial angles to either answer here.
Yeah, I think that's a good answer, because certainly you speak from a position of relative strength. But do you think, for more than LCP? Do you feel that there's more general appetite for, I don't want to use the word re-risking, I hate that phrase, but you know what I mean?
Yeah, I mean, to pick that point up, just the analogy I have around this whole situation is driving a car. And I think 20 years ago, there were lots of schemes driving at 100 miles an hour. There's some high profile crashes, there were some problems, and the regulatory change then of de-risk, slow down was right. Cars are driving around today at 2 miles an hour and planning to go to 0. And I think maybe they should go back to driving at 20 or 30 as safely done. So it's sort of, it's a re-risking per se, but it's not aggressive. Yeah, I mean, it's a nuanced situation. There are 5,000 pension schemes. There were however many consultancies, all have different business plans, and everyone's known about this issue for 50 years of DB pensions probably heading in one direction. Can't speak for the industry as a whole. I think the interesting angle that we've seen even in the past month has been a renewed focus from those in government on, should we be getting pensions assets working harder? Is there a better answer here? And one chart that we've shown them is there's a lot of focus about DC assets, and let's get that 200 billion of DC assets working properly like they do in Australia. And we've tapped on shoulders and said, you do understand that there's 10 times that amount in DB assets, and maybe we should think about that too. But in terms of sort of industry-wide, country-wide positions at the moment, the enthusiasm for finding a more productive use for this money seems to be growing.
I'm going to come to Con in just a second, because I can see he's got a hand up. And Con, you might like to take yourself off mute while I ask this next question. Okay, so What did the government say when you said to them, by the way, there's 10 times as much assets on the DB side as on the DC side?
I think it's understood. I think it's recognised that it's a bit of a harder pot of money to do anything with, given the history, given the trustee nature, given everything else. But I mean, government is a single term for quite a broad range of organisation, people, experience levels, and everything else. So we're trying to spell out how we see the world, and hopefully it lands.
Yeah, so government, you know, from their pronouncements, you'd think they'd given up on DB and just basically said that's done for. Oh, right. Go on mute again, Con.
I'm
Sorry,
actually listening to this thing at the moment. I'll give you a shout.
Okay, well done. Yeah, so do you feel that there is an appetite in any part of government, and if so, where were you seeing sort of interest in your views?
So I think the Treasury angle is the most interesting of this type of idea, because Treasury likes money. There's a lot of money in DB schemes. There is a lot of uses for that we are struggling with as a country, whether that's investing in net zero transition infrastructure. Can we get the long-term investors to fund that? I think the other angle, which personally I think is underappreciated at this point, is the looming DC saving crisis. I don't know if anyone's read the PLSA's recent research on that, but when you look at the numbers that are being saved into DC pots, I think we are facing a huge problem in the decades ahead when Generation DC work out that they can't actually retire. So to the extent investing DB assets more properly for longer can help with that problem, I think that's a big groundswell. I think the challenge there is that it's quite hard for the government of the day to prioritize problems that are 30, 40, 50 years away. So whether that's the route in or not is to be seen.
Interesting. Now, Con, so yes, again, I'm going to get you to toggle that unmute switch and ask your question. Yeah.
Sorry about the phone call. I apologise for that. Ordinarily, I'd been on mute, so you wouldn't have been aware of it.
That was my fault.
Steve, I think there's a very simple way beyond the fiduciary duty interpretation or supposed problem, which is that if we have full benefit coverage by the Pension Protection Fund, then there is no question of harm to members. And the matter of how you run the scheme is then entirely a matter for the trustees and the company. That puts a very different complexion on the whole thing. It also would carry with it the consequence that the new funding regulations, which are entirely motivated by the fact that members can possibly lose by going into the PPF, goes away. And the additional contributions that might be necessary are actually trivially small because of the fact that most schemes are now closed and running off.
You may have missed Steve's initial comments, but one of the proposals that LCP has rather remedies the problems that you're talking about with the PPF. Did you hear that, Con?
No, I didn't.
Oh, right, Steve, perhaps
I was still struggling to get on at that point.
Yeah, and I've just hit present. Can everyone see a slide that I've just put up?
We can.
So this is a deck we've been talking about for some months with various groups, and effectively we think there should be a new system. We think it should be an opt-in system, so it doesn't carte blanche apply to every scheme. But if you opt in, you do two things. You pay a higher PPF levy in exchange for 100% coverage of your benefits through the PPF. And then you have a mechanism to release ongoing surpluses. That mechanism, I imagine, will be a bum fight from every stakeholder involved as to I want my piece of the pie, but something that allows you to get money out on an ongoing basis. That then changes the incentive structure. As you've identified, Con, the PPF 100% cover should, in theory, relax trustees to say, well, hold on a sec, we've done all of this de-risking to try and achieve the final 10% of certainty for the bit that the PPF doesn't cover. Job complete now. And therefore that leaves the scheme possibly in the arms of the employer to say, right, what do we want to do with this asset, this corporate asset that we've now got on our balance sheet? Let's invest it more properly. Let's grow it. Let's use the surplus for various purposes.
Okay, I think that's very sensible. I'll offer you one idea for liberation of surpluses once you have full PPF coverage. One of the principal objectors is going to be HM Treasury because of the 35% tax that they apply to liberations from schemes. I think you might want to consider allowing tax-free liberation, providing the funds are used by the sponsored company for qualifying capital investment purposes. And they would typically be green or infrastructure or whatever that you can write in a small piece of tax legislation. But that's, yep. I think that's a way of removing what is likely to be the major obstacle to liberation approaches, which would be HMT.
Yeah, I think the deal for HMT is, there's a few facets to it. I think the deal is you can have some influence over how these schemes invest. The whole idea here is that a portion of schemes carry on running, investing for growth. Because it's an opt-in system, you can say within the rules, 10% of the assets have to go into a government-approved long-term investment vehicle for infrastructure transition or whatever. I think there is a point around surplus extraction and what it goes on. My view is that a priority, speaking as a citizen, speaking without agenda, is some of that should go on improving DC saving.
Yeah.
Whether that's a Treasury priority or not at the moment, to be seen.
Actually, yeah, it's possible for surpluses where your schemes are appropriately set up, and if they aren't, it's not that difficult to do it. But it's perfectly possible to apply surpluses now into a DC section.
Yep, and we've got clients who do that. Increasingly, a minority of schemes have DC benefits in the same trust, but where they do, we've got a number of clients who have already taken this decision. We'll run on the scheme, we'll use it to pay DC benefits. Yeah.
XPS actually talk about setting new schemes up within DB arrangements specifically for the purposes of improving member benefits. Are you seeing any sort of scheme design changes, Steve?
Yeah, it's early days. It's an interesting one, that, because again, lots of schemes and lots of companies over the past 10 years have gone the other way and said, let's simplify, take the DC out, go into a DC master trust, the efficiency benefits of that, whatever else. So going back against that, having already done a project is one challenge. But yeah, for the schemes we're looking at this with that already have the DC in the DB trust, that's an obvious route to use the surplus.
Yeah, okay, well, it's encouraging to hear that. I know that there's been a couple of questions in the chat. I think I'd like to ask John to ask the question directly. John Spain, could you ask your question directly about how these surpluses are defined, or would you like me to ask you on your behalf?
Thank you. I don't know if I can be heard. Can I?
Yes, you can.
Okay. Somebody's unmuted me then. I didn't spot that. I think the real problem goes back to around 2000, when the UK actuarial profession allowed itself to be swayed by a few individuals into going into mark-to-market, which really, really has never, ever worked for long-term financial entities such as DB pension funds. And then you had TPR completely ratcheting up the so-called protective steps to make sure that nobody would lose ours. at absolutely colossal expense. If you are going to release money on the basis of a mark-to-market, very prudent, well, it's called prudent, but we don't know if it's prudent because nobody looks at the best estimate against which you can only assess prudence. So are we talking about monitoring these surpluses on a true best estimate plus a margin for prudence, or are we talking about sticking with what we have been using for the last 20 years or so, which, as I say, really doesn't work? And in fact, the real problem is using a discount process at all, because having one number representing the future, which is without any indication, true indication of volatility, is insanity. So I'd be grateful for LCP's views on what they really think about funding, please. And now I'll go back to mute.
So a good grenade to throw in the room with 5 minutes to go. I mean,
you've got 35 minutes, Steve.
I've got 35 minutes. Oh, well, okay.
I'm sorry to say you're going to have to eat this one out, old boy.
Yeah,
so
I'll get going then. Yeah, so a few strands to that. So I like asset-led discounting as a concept. I've got a number of clients that use it, that invest in a broad range of assets, set a discount rate based on each asset, and then work out what their liability value is today based on that. Personally, I do think you probably have to translate all of the pension payments into one individual number, one single number of what the value is today, to at least give you a benchmark to aim for. Yes, there should be some stress testing, scenario testing around that to help understand the volatility. I think one problem that we've seen emerge over the past 20, 25 years is just because you can measure something every day doesn't mean it's helpful to. So I think we've had a lot of focus on quite short-term thinking in terms of the value placed on liabilities and funding positions and actions taken to reduce short-term risk, and fundamentally pension schemes should be relatively long-term investors and take a long-term view. So I think what we're proposing here helps re-unlock some of that, because they've got an incentive to take a long-term view. I think the gilts-based discounting, how we're seeing this work is it works fine within the new funding rules. So I'm envisaging that there has to be a yardstick at over above. You can extract some surplus. You can't possibly say you can take some money out regardless of funding position. I think it would be perfectly fine for that yardstick to be if you're fully funded on the TPR's new fast track funding basis. Gives you a common ground, gives you a common view that it's only schemes that are sufficiently well funded that are able to start taking money out for other things. Yes, there are pros and cons. If that's gilts plus a half, there are pros and cons of measuring liabilities in that way. But I think we are fundamentally talking here about schemes that are already very well de-risked, very well funded, very well positioned against that type of view on the world. Loosening the purse string slightly to allow them to reinvest a bit more in productive assets, but probably not moving a mile away from that definition of how a scheme should be funded.
Okay. Can I move the conversation on a little bit, because on the other side of the fence we have buyouts, and for decades the view was that buyout was the gold standard. But that's been called into question recently by a number of people, not least because we see sort of phrases like the rush to end game, which sounds suspiciously like herding to some. What's your views? Is there an argument to suggest that there could be equivalent security in an occupational scheme, and that actually buyout is not the gold standard for member that it's always been claimed to be?
So, I mean, buyout, it depends what your comparison is. If your comparison is a scheme with a relatively small, relatively weak employer, or a buyout under the insurance regime with a household name that has hundreds of billions of assets under management, then I think buyout, quite rightly, is viewed by trustees in that situation as a gold standard, as an aspiration, as something that is probably hand on heart better for their members. And I don't think that's going away. I think even if the rules of the game are changed as we're proposing, I think there will be a minority of schemes at certain sizes that say that all sounds fun, but at our size, in our position, it's not worth it. We haven't got the governance time. Actually, it's better for our members to be in the insurance regime. Yes, there are new potential issues being thought of now as many schemes emerge closer to a full buyout transaction. I mean, quality of administration is one that I think going back even 5 years, I don't think anyone thought much about. But we saw the news with Capita recently, and actually for a trustee to go through that process and think really hard about what they're handing over and what they can think might happen over the decades ahead. And I think under our idea, you're effectively saying for some schemes, let's replace that gold standard insurance regime with its 1 in 200 year underwriting with 100% coverage from the PPF that is a department of government that has assets that behaves prudently. I think you could argue that the PPF in its current form is less secure than the buyout insurance regime, certainly in terms of history and track record. So I think that there are questions still to be asked there. Whether the PPF is quasi-government, and if the worst happens, then it would be stepped in, or government would step in to save it, don't know. But there's certainly a debate to be had on security as to, even with 100% PPF guarantee, whether the buyout regime is actually a better standard to strive for. So I definitely don't think that buyout is the wrong idea and everyone's got it wrong by thinking it's the better answer. I think for larger schemes, for those with very, very strong sponsors, there's definitely a debate to be had.
Okay, we might come back to this. I can see a couple of hands up. I can't work out whose hand went up first. I saw your hand go up, TC. It's come down again. Do you want to speak?
Well, thank you very much, and thanks, Steve. Really, really interesting points. And I've been a very big believer for a number of years that actually the status quo isn't optimal. The question I had, the reason I put my hand down, is actually Henry sort of asked it, which is that bearing in mind that it looks very likely there is a better alternative out there that will be better for members and also better for sponsors. Isn't it time we stopped calling buyout gold standard and maybe deregulated it, or or diminished it to bronze standard? And in line with that, it seems that the whole industry has been incredibly keen to annuitize everything, but there seems to be very little analysis done that's been driving those decisions. So very little analysis of whether a member is particularly better off in an insurance regime or within the PPF, because the financial services compensation scheme is unfunded and untested, whereas the PPF is funded. And also on the corporate side, there's very little analysis that would support the rationale for a sponsor annuitizing. And that's been a challenge for a while. I think it's something that I've been very passionate about. But I wonder, with your new hat on, or LCP's new stance, whether now is the time to actually do a bit more analysis into these deals, or would there be an internal sensitivity or a conflict if actually it's not been the right thing to do if it has been that bronze standard?
So I think, don't get me wrong, plenty of analysis gets done by trustees, advisors before doing a buyout deal, by their lawyers. Well, what are we getting here? What are the protections? How does it compare to the status quo? I think when schemes were, in recent memory, less well funded, PPF was covering 80, 85, 90% of the benefits. There was a very real chance that if we don't do a buyout, we might slip back into deficit. No corporate sponsor is infallible. There are scenarios where our members get less than 100%. If we can go secure a buyout for 100% that sits under the insurance regime, and yes, doing our due diligence on that insurer's financial position and how that regime all works, that feels like a very good answer for trustees, and that's been a decision that many have been happy to make. I think from the corporate point of view, point made earlier, I think corporate perspective, again, if you're used to a DB scheme being a drain of cash, and every 3 years some people come in and say stuff you don't quite understand about longevity, and then you have to give them more money, and that's the only direction of travel. And now you've got people in front of you saying you could be rid of this and pass it on and sever the link. For many corporates, that's a very attractive proposition, something they've been happy to do.
That feels like more of an emotional decision rather than a sort of a decision that a CFO might make based on information about the impact on their share price, for example, whether they were to go down the annuitization route or to run on. And that seems to me the kind of where there's been a real gap in any real analysis by the industry.
Yeah, partly. But I think shareholders, impact on share price is an interesting one, because I think for the past 20 years, the vast majority of share prices have been impacted negatively by the presence of a DB scheme. It's cash drain, everything else. And actually, often from a corporate perspective, a big buyout deal that secures the benefits and removes the cost and risk of the scheme on the sponsor is viewed very positively.
But there's no analysis to base that up. I think that's a hunch that's driven the whole industry. And I'm working with an undergraduate who's studying this for her dissertation, and there's no analysis in the UK that she's been able to find. There's some in the US
on corporate share prices,
on corporate share price post deal, whether there's any meaningful impact, positive or negative.
I think it's generally viewed as a risk. The scheme is a risk; it's not an opportunity. And I think under the current rules of the game, that's true. There are very limited scenarios where the corporate gets anything back out of this scheme. There are plenty of plausible scenarios where they have to put more in, and hence it's viewed as a risk. And if we can close off that risk, often without even having to write a check to get rid of it, why wouldn't you? And that's been the position that's been commonly adopted.
Okay. Thanks, TC. I can certainly see the moral hazard argument about having 100% funding from the PPF. And I wonder if you want to comment at all about that. But before I asked that question formally, Con, you've got a question, and Chris, you've got a question. I'm jumping ahead of you in the queue. So, Con, you're on mute, mate. I knew I'd catch you out in the end.
Right. I also have a comment before asking the question, Henry. There is no question of moral hazard with the PPF. Okay? Yeah, and if you want to know more about that, I'll send you a link to something I'm doing tomorrow, which is explicitly on what moral hazard is and isn't. There was no justification for paying benefits which were less than full when the PPF was set up, and the Treasury knew it full well. Anyway, Chris, what I wanted to touch on is a couple of things. The first of which is just how well are schemes actually funded. I've been doing work collecting published results since the beginning of the year, and I've got about 300 of them. And where the PPF has 40% or more schemes funded at 130% or more of Section 179 values, I have a very small fraction. I think that based on the numbers that are being reported publicly, that I've collected by speaking to people, that we probably don't get to 15% of schemes capable of doing buyout. That they are just not sufficiently well funded, that the PPF funding levels have been very misleading. I mean, one of the indicators of that was the ONS survey results for assets at the end of September. How well funded are the schemes that you're advising and so on? And do we really have an imminent ability for lots and lots of schemes? In PPF world, almost 50% of schemes would be sufficiently well funded to go to buyout. That strikes me as wrong. where where are you seeing schemes funded? How many could do buyout today?
Yeah, so we think 90% of schemes schemes on average are 90% funded on buyout. And I haven't seen the latest numbers myself, but I wouldn't be surprised if the LCP analysis is a third plus are able to do it right now, of those who haven't done it. Whether you analyze
You
it
think as
based
many
on,
as a third of schemes could do?
I think the TPR said last week in the AAFS that they thought 25% of schemes were fully funded on buyout. Some views of buyout pricing vary. I mean, there's the obvious question of there's a theoretical price that you could transact at, but seriously, if 2,000 schemes try and do it at the same time, that price might go up because of supply demand. But I think in terms of funding position, I've seen nothing to doubt the general reported position that vast majority of schemes are at or pretty close to that gilts plus a bits funding level where a buyout is theoretically possible.
Okay. I'll send you an email of the piece of work that I've done.
Sure.
You can swap some notes.
I expect it will find its way onto my blog in due course. Chris Bunt, you've had your hand up for a long time.
Cheers, Henry, and thanks, Steve. And yeah, I'm a big fan of making the money work harder, as you know, in pension schemes. There's been a lot of sort of publicity sort of over the recent years and a lot of work done on improving the gender pay gap and equality in pay. By sort of gold plating the DB schemes and de-risking, the gender pensions gap is actually kind of getting bigger effectively because the money's being diverted from current earners to gold plate the pensions of sort of senior execs of yesteryear. Has there been any sort of support for these proposals by any equality groups? Are they aware of the issues and the benefits of sort of money working more efficiently in a pension scheme?
Yeah, I think that's a really good and pertinent point, and one that we're working out the best way to draw out. I mean, in some of our public materials, we've sort of used the phrase as a growing equality between the pensions haves and the pension haves nots in this country. And I inserted, which got deleted, the haves being generally older, more male, whiter, etc. But that's the truth of it. And yeah, there's a simple generational inequality just in terms of expected retirement outcomes. So absolutely, if the pot of money that's there for the executives of yesteryear can be invested more efficiently in some of the bonuses shared across the current generation, then that can be a force to help with that. We have had some contact with groups interested in that angle. The other sort of semi-related point is the whole climate change, net zero type aspects of this too, and if this can be a route to freeing up money to invest in that problem, again, is there good that can be done here with a big pot of money rather than just passing it off and letting it exhaust itself?
I did have a secondary question, if that's all right, Henry. It's just well, more comment also almost on the PPF stuff, because PPF's been mentioned quite a lot here, and I know they're rightfully proud of their investment record and how they sort of generally return more than schemes. How have they been sort of contacted about the proposals for them to sort of ensure 100% or cover 100%? I can imagine potential issues around administration with all schemes having different benefits and things like that.
Yeah, it's an interesting angle. I think there's no harm in saying we met with the PPF back last September to walk them through this idea, given their role in it was quite fundamental, we thought, to it getting off the ground. We didn't leave the meeting with the ability to quote them publicly that this was the best idea they'd ever heard, but they were receptive. They thought we were walking in there to offer a view of what their surplus should be spent on. I mean, I'm sure everyone in this call knows that the PPF has been a great success and it has a large surplus. They thought we were going to say, let's spend that surplus on providing extra cover. We don't think that's actually necessary. We think just the schemes would pay a higher PPF levy. Clearly, I mean, their setup is to be risk averse. They want to cover the risk of things going wrong. So it does introduce the the idea that maybe schemes with that 100% ticket in their back pocket start investing too aggressively. So that's something that I'm happy to talk more about. On the administration front, the original idea was actually you have a route of standardizing the benefits even to an 100% value. So one of the benefits of the haircuts that are applied currently is effectively all the schemes get translated onto a PPF set of benefits, which is then possible for the PPF to administer. If you're saying now, scrap that, the members should get full value, it does introduce the potential challenge that you've then got the PPF trying to administer infinite levels of different benefit structures, all these knotty little schemes that have come up with weird benefit structures for whatever reason. So we were proposing that you do a sort of actuarial equivalent value test where you say, okay, this scheme's fallen in, we'll translate you onto one of 9 benefit structures based on what's going to be equivalent value as signed off by the actuary. Their view is actually that just gets too hard, because inevitably then, although the actuarial average will say you've got an equivalent value, there will be a member with no spouse who's lost out, or etc. There will always be someone who's lost out through that process. So their view, I think, was there are already administrators administering all of these schemes. There must be a way to just keep them running as they are, and we'll make the administration work and not need to make that change. But yeah, that's one area of difficulty that I've positioned this externally as 2 simple changes to unlock DB pensions. And when you make 2 changes, like we're suggesting, there are 10 levels of different complexities that emerge from places you've never even thought of, and that's probably one of them.
It's really interesting. How much of this is being shared? Because you're sharing it here, obviously, but this is pretty radical stuff. Is this out in the public domain? Is it something that we can recognize as LCP policy, or is this something that you're sort of like shooting through this forum to see how we react?
So far we've been doing a little bit of the latter. So I think we started talking about this just over a year ago. We have spoken to large professional trustee firms, pension legal firms, PPF, as I mentioned, various Treasury representatives, DWP, shot it across the bows of TPR, and then hired David Fairs from TPR, which removed the need to do that loop formally. So we've been talking, sort of road testing, working out, basically, let's talk to as many people as possible and wait for someone to say, no, you're talking nonsense, it doesn't work for this reason. And some have suggested we're talking nonsense, but no one's come up with some reason of saying that it doesn't fundamentally work. So we're now getting to the point of talking more publicly about it. We're planning on doing an external event on it in a couple of weeks, which we're about to publicise. We used the DWP's call for evidence last week. So DWP issued 9 questions, fairly wide ranging. What should DB pensions look like? What are the issues? Should we have more open schemes? That sort of thing. And we put a response into that basically said, we're not going to answer all of your questions, but let us use our 5 pages to outline how we think the world should work. So we've given them that information and gone and spoken to them provisionally around it. So it's getting out there softly. We've not done a big brand launch of the idea yet, but we're talking to people.
Presumably that submission will be published on their pages. I don't think it has been yet, but maybe it hasn't.
I don't think it has been yet. I think it will be. As identified earlier, it's an interesting position for sort of LCP to adopt on behalf of everyone at LCP and all of our clients, which is possibly not quite yet the case, but it's something that has support of our pensions leadership group. That submission's been signed off by Michelle Wright, who's our head of pensions, and Steve Webb, former pensions minister, and I've got my own name on there as well, just for posterity. But it's something that it's an idea with support within LCP that we think is a good idea.
Yeah, that's very interesting. So you've actually got David Fairs, you've got Steve Webb, you've got a fairly big chunk of pension policy making and policy regulation over the last 10 years inside your organisation. What's the thinking behind that? Are you wanting to become lobbyists, or are you wanting just to become thought leaders, or is it a combination of the 2?
Certainly thought leaders. We want to be a firm that's at the forefront of making things better and coming up with ideas. I mean, I've been working with Sir Steve Webb on this, and it's remarkable the impact having someone like him around can have in terms of our ability to talk to people, to get input. He's also quite a smart chap that's been around the block a few times in terms of how these things work. So, I mean, having people like that in the building has a big impact on our ambition as a firm and what we can do. Do we want to be lobbyists? We want to be ambitious. We want to challenge if things are happening in one way. Should they happen that way? Is there a better way? Having people with the right influence in the right circles is a huge benefit to that way of thinking. So we see ourselves as, I mean, I've already mentioned it, but the powering possibilities brand line. Other parts of our business, we've got an energy transition team that's trying to help the world challenge and transition to net zero. We've got a healthcare analytics business that 2 years ago didn't exist and now has dozens of people that's trying to improve healthcare provision in this country. We're trying to make things better, and this idea on pensions fits within that mindset.
It's really interesting. John, you've got a hand up again. John Spain, do you want to come off mute and ask your question? Thanks.
Thank you. Something completely different, and that is around certifying that benefits are equivalent in value. Can I point you towards what Government Actuaries Department used to do in public-private transfers, making sure that people would get future service benefits at least as valuable as what they'd been enjoying? Broad comparability. That was generally accepted as pretty robust. And if you talk to Bart and Alex, they were very heavily involved in this 20-25 years ago. So they're the go-to people in your firm.
That's very helpful. Thank you.
Should help PPF understand that this is not a question of some actuary saying, yeah, 2 equals 3, that's fine, which is what they've been doing for so long.
Okay. You did mention that you felt this wasn't about reallocating the surplus of the PPF, but this would be funded by ongoing levies. Can you explain a little bit about why you're taking that position? Because it's not one that I would intuitively adopt myself. I'd like to see the levy gone. I'd like to see the surplus used and the surplus to be regenerated by better investment in growth opportunities.
Yeah, it's a good question. So, I mean, the model I like to have in my mind for all of this is the car insurance industry, and we all pay a little bit of a levy every year to portion off some of our risk to a central pot, and then vast majority of us don't crash, so that pot covers the risks that emerge, and that model has worked for the PPF, and I think no reason it can't continue to work. Yet, yes, there may come a time. I mean, the PPF has now got to a point where I think it would effectively like to turn the levy off because it doesn't need it. There's just a challenge, there's a technical challenge that if they turn it off, it's then very hard for them to turn it back on again. So they're being a bit cautious with that. So we started from a position of, yes, let's have a levy to pay the increased risk. It might be the increased risk is 10/9, you're taking coverage from 90 to 100. If you're then going to adopt a more risky strategy, then maybe the levy goes up a little bit further for that. But we didn't think it was transformational, and we think the win for corporates that might support this type of approach far outweighs many factors any sort of levy change. So we thought that's the simplest, and also just politically it has a sort of look. Yes, these schemes in theory present a bit more risk, but they're paying for their risks, they're covering their risks, so sort of it's all fair. But under that model, I mean, the same thing might happen that's happened with the existing PPF, that those levies get paid, the pot grows and grows, the performance of the assets, both of the schemes that are investing, but also the PPF itself is sufficient that at some point we can say, no, it's not needed anymore. Because
somebody nodding his head very, very violently over in the corner of my screen there. Mr. Keating, do you want to come back on that? You're on mute, of course.
The argument in favour of using a levy rather than the current surplus is a very simple one. The amount of levy that's going to be coming in is going to get smaller and smaller in line with the level of outstanding liabilities. The increase in risk drops off a cliff once all scheme members are in the pensioner in payment level. It's perhaps 5% of the total payments, or that's the amount of the PPF lowering of pensions payable. It's just going at it from the standpoint of using the current excess reserves really doesn't make sense when you think how little the increased risk is being, how much real increase in risk there is in here, simply because of the way and the rate at which it decays.
Yeah.
If you were to spend the current surplus on that, you would effectively be destroying a capital asset for very small amounts of money over very long future periods of time. Much better to match cash flow to cash flow. The tricky part in here, though, is going to be how you handle open schemes in here, because open schemes are going to become an ever larger part of the PPF coverage base, simply because all of the closed schemes are going to run off. The current schemes are going to inflate at something around our levels of wage inflation. And that is going to take a little bit of thinking about.
Yeah, so agree that open scheme nuances are harder and often forgotten. I think the first draft of the regulations we're consulting on at the moment effectively forgot about open schemes, so it's not always the first thing you think about. I think on the other point about the diminishing risk, I mean, the way I think about this is with schemes so vastly well funded, and take your questions earlier, Con, as to whether all of those statistics are true or not, but let's assume they are for the purposes of this.
Yeah.
The collective pot of money that is set aside to pay these pensions is vastly too much, in my view. If you take a best estimate view of it, if you took that pot of money and invested it like an endowment and just said, we're a multi-decade investor, we've got these liabilities. Yes, actuaries like to say that they're all very difficult and they might double tomorrow, but long-term people running on and then eventually not running on is pretty steady state. There's a huge profit to be made. If you took that 1.5 trillion and invested it in an endowment and made 10 to 15% per annum, there might be another 1.5 trillion more left at the end.
When you've got something that makes 15% a year, give me a call.
There are plenty of endowments have consistently made 10% at a time when cash rates were 0, and if cash rates are now 4 or 5, then it stands to reason there's more money to be made. But even if it's 10, even if it's 6 or 7, there's plenty of money there. They're discounted, assuming they only get a little bit more than gilt rates, and they're still fully funded on that basis. So find a mechanism to invest them properly. This is a huge asset to the UK, and I think we should be being ambitious about how we use it, not worried about the 99.9% scenario where something goes wrong. But anyway, I'll get back off my hobby horse.
No, stay on that hobby horse, because it was a delightful hobby horse, Steve, and I think there were lots of nodding heads there saying, yeah, thank goodness somebody who is in an actuarial practice such as yours is saying these things. We're coming to the end now of what has been a pretty important, I think, seminar. I don't think we often discuss things like this in this way, and I'm really grateful to you for coming on it. There are things we haven't touched on, and I know Chris Giles is sitting there in the corner talking about it. One aspect that Chris was asking about was tax. And these surpluses are tax incentivized surpluses. You know, they're, to a certain extent, we all own any surplus because we all gave up our tax to make them happen. Do you feel that there is some kind of opportunity for a government to argue that they can intervene at this stage on behalf of the taxpayer to make sure that the taxpayer's money is properly used?
I wouldn't put it past them. Yes, there were tax incentives to support saving for retirement. I think those are probably there for good reason and needed, and it's in the economy and every one of our interests that adequate retirement savings are made. Otherwise, we end up with aging people that are unable to retire, probably unable to do the job they were doing, and there's a huge problem there. So it's an interesting angle, and someone mentioned earlier the sort of 35% tax on refund as a consideration that the Treasury have got their eyes on that. One point I make to say on that, and I've not got the stats, but my perception is that 35% tax charge is not paid very often because everyone plans to not pay it, and whether that's buyout before you get a surplus, which feels silly to me because look, 65% of something is still more than 100% of nothing, or just members' benefits get augmented so the surplus isn't there, so no tax is due. So if given the opportunity, which we haven't had yet, I think on Treasury side, I'd try and make sure that they're visible to the fact that 35% is not likely to be applied to huge swathes of money.
Bit like the LTA then. E.g.,
Well,
it's something that everybody knows about and gets round because they're clever enough to do so.
Possibly, yeah. Although that's kind of the purpose of it, isn't it? That will only give you so much tax saving up to a point, and then you have to stop and find a different way. But
yeah, but they've ditched that, so maybe they'll ditch the 35% because they don't need it anymore. It's the kind of tax simplification I'm favourable. Anyway, Con, you've got your hand up again. We're coming to the end. But
yeah, it's just on this tax thing. Currently, liberation, a repayment of surpluses to the sponsor, really doesn't happen because very few actuaries will sign off on the existence of a surplus until the scheme has actually been fully wound up. You know, I mean, the few examples that I've seen where that tax has been paid has actually been where there's been a surplus even after they've done buyout. Okay, so very little, the tax receipts from it are negligible. Yeah.
I think we may have reached a point at the end where we have exhausted the conversation as far as we can today. Unless anybody's got a dying need to ask a question, they haven't done so far. Okay.
So it's great. It's great that we're talking about innovation within this space, and thank you very much, Steve. I think everything you said makes enormous amounts of sense. It's just a shame that the rest of the industry is a little bit behind the curve.
Yep, let's hope. Let's hope.
All I can say to that is I think there are more people saying these things than there were a year ago, and hopefully in a year's time there will be more, and hopefully we've had a chance to drive some change. But I mean, yeah, how likely is it? I think that the rules of the game are tweaked so radically that I've described. It's a small chance, but it's worth a go, isn't it? That's our position.
It's a small chance, but it's worth a go. I think that we would all want to make it a bigger chance. So thank you for bringing it to our meeting, and we'll go away and think about what you say, and hopefully we'll have more meetings of this kind with more people on them. But thank you to everyone who's come on this call. It's been very, very good. And most of all, thanks to Steve for putting his point of view so calmly and so accurately and with such passion. So with that, I'd like to close the full bit and just say that next week we have another speaker who will have a completely different perspective on pensions, Romy Zaverva, who's the CEO of Pension Bee, the yellow peril, as she is likely to be known amongst many in occupational circles, not by me. And she'll be speaking really about the quality of service that's being achieved outside of occupational pension schemes, and whether this can be a benchmark for the service which is achieved inside occupational pension schemes. Interesting conversation that will be. Steve always asked me to end by saying, let's pray for peace in the East, and how long we've been saying that. But let's do that anyway. And let's hope that when we get to meet later this year, we'll be able to discount that little phrase. Okay, thank you very much, everyone. And most of all, thanks to Steve. See you next week.
Thanks, everyone.
Thanks, guys.
Thanks.